Hello and welcome again back to the final day of August 2023. Summer just flew right by. It was a beautiful summer though. I loved every minute of it. So lots to get into. It's been a crazy busy year. I know I've been saying that every single month, but this month, just like the last, was extremely busy. Lots to get into. So we're going to be looking at the credit downgrades. There was both a U.S. credit downgrade. What does that mean? As well as a number of different institutions, financial institutions were also downgraded. The Fed had their annual Jackson Hole Symposium, which is where a whole bunch of central bankers get together, along with academics and financial institutions, media, and they discuss policy. And it's not really a venue where they're going to actually hike rates, but it is a venue where they're going to give further guidance. So we're going to look at that as well. Got more inflation news, home value updates, and then mortgage rates as a whole had a wild ride. Similar to last month, it was definitely a roller coaster ride. They started the month off around 7%. They got all the way up to 7.375, 7.5%, right around there. And then just in the last few days, they've made some improvements, and now they're back down to around 7%. So we're going to be talking about why those rates increased. And for all those parents out there, it's back to school. Whenever I see back to school, I feel like singing Adam Sandler's song from Billy Madison. Back to school to prove to dad that I'm not a fool. I can't see back to school without saying that. So let's talk about the credit downgrade. So as you all know, your personal credit is rated by three different agencies: Experian, TransUnion, and Equifax. Well, just like us consumers have a credit agency that reports our credit scores, so do countries. Bonds, treasuries, all that stuff has credit agencies that give them different ratings. The higher the risk, the higher the rate of return you would expect to receive with that investment, right? The higher the risk, the bigger the return you would expect, right? You should be getting something for your additional risk. Well, with regards to American credit agencies, there's really three big ones. So there's Moody's, Standard & Poor's, and then Fitch. Well, Fitch on August 1st, so first day of the month, they downgraded U.S. credit from a AAA rating down to a AA+. It's not rated like yours and my credit is rated, which is like 350 to 850. It's rated on a completely different scale, but they did downgrade the U.S. credit rating. It's not necessarily a surprise that the U.S. credit rating was downgraded, especially after we barely escaped financial crisis with the debt ceiling. It's not terribly shocking that our credit would be downgraded. What's more surprising is when it was downgraded. It was downgraded well after the fact. So that was definitely a curveball. Again, it's not that it was downgraded, but it was when it was downgraded that really spooked the markets. And that kicked off the month, and that's what started rates increasing. Again, higher the risk, the higher the rate of return you would expect to receive as an investor. Well, that was on August 1st. The following week, we got another couple of downgrades, but this actually had to do with financial institutions. So Moody's. So the first one was Fitch. They grabbed some headlines by downgrading the U.S. credit, and then followed the following week by Moody's. Moody's cut a number of different credit ratings for a number of different institutions. They actually downgraded the rating for 10 different mid-sized banks. They added an additional 6 as under review, which means they're taking a look at them, and then 11 as having a negative outlook, saying these could be on the horizon if things don't change. So earlier this year, when we saw a number of financial institutions fail, there was a couple of recurring themes. One was low liquidity. They did not have enough cash on hand. When people started withdrawing money, it means that they had to start selling some bad bets. Those bad bets were treasuries. So when treasuries were paying a very low yield, a very low rate of return back in the day, just a couple of years ago, even the last year, now all of a sudden they started having to liquidate some of those bad investments, and it compounded the issue. Now they were selling losers, and it was causing a bigger issue. That's what they call a bank run, when the bank can no longer keep up with withdrawals on their accounts. So low liquidity compounded by the effect of making bad bets, specifically U.S. treasuries. And they were, generally speaking, exposed to one sector. Not always the case, but for the most part, they were exposed to a single sector. Startups, tech, that was a big one at the very beginning of the year as well. Well, the recurring theme from this set of downgrades has to do with commercial loan exposure. This is Moody's saying, hey, there's a lot of institutions that are too exposed to commercial risk. Now, why is commercial risky, generally speaking? Well, there's a couple different reasons. One reason is All commercial loans are going to be a portfolio loan. Portfolio simply means it's the bank or financial institutions, credit unions, whatever, their own personal money that they are lending out. Well, financial institutions are very quick to lend out the government's money. Fannie Mae, Freddie Mac backed loans, FHA, VA backed loans, all that is government backed money. There's a secondary market for them. Fannie Mae, Freddie Mac tells the lender what rates to charge. Lenders charge that, maybe a little bit above it. But that's how that works. There's a secondary market for this. There is no secondary market for commercial loans, though. So it's the bank or institution's own personal money. That's problematic for a couple of reasons. Number one, financial institutions have been getting squeezed. Because of all the Fed rate hikes, financial institutions have been getting squeezed. And if they're getting squeezed, they're going to start doing less portfolio loans. They want to hold on to more of that money so that they don't become the Silicon Valley Bank or the Signature or the First Republic Bank that did not have enough capital on hand. So they want to keep more of their capital on hand. And commercial loans are one of the first loan types that kind of fall by the wayside. Lenders are going to start easing off of that financing just because they want to keep more of that cash on hand. And again, there is no secondary market. So every penny they lend out is one less penny that they have on hand. So that's one reason. The other thing is commercial can be a little bit more risky. Commercial typically comes with higher risks. It typically has higher rates. And another thing is they tend to be shorter term loans. They're under review every year or two. And they're under review every year or two because the financial institution says, hey, look, we want to see your tax returns. We want to see your books. We want to see how your businesses are doing to make sure that we can go ahead and re-up, go ahead and do another loan for you, sign up for another year or two or 5 or whatever the case may be. Well, all of that is causing potential risk in the market. With rates rising, those institutions or those companies rather may not have enough money to be able to make those payments as those rates have risen. They tend to be adjustable rate mortgages. If they're adjusting right now, that's problematic. Businesses as a whole have been getting squeezed because of these higher rate environments as well. So just a lot of different pieces to the puzzle here. Now, none of these have failed. Yay. But Moody's shined a big light on it and said, hey, this could become an issue in the future. So everybody's keeping an eye on it right now. Again, no failures, additional failures to speak of yet, but something worth keeping an eye on as a whole. Next, we had the Jackson Hole Symposium. So that just wrapped up on August 25th. So just a week ago. So every year, like I said, the Fed holds a symposium in Jackson Hole, Wyoming. They invite central bankers, academics, financial organizations, media out there. They discuss policy. What is and what isn't working? What are you all seeing in the market as well? And again, not a venue to actually increase rates or come out with additional rate hikes or rate changes of any sort, but it is a venue where they can give additional guidance. Here's what we're expecting. Well, Jerome Powell acknowledged that progress was being made on inflation, no duh, but that it's also still too high. He also mentioned that the Fed is prepared to raise rates further. They've come out and said that at their last Fed meeting as well. And they want to keep fiscal policy restrictive. What that means is we know that we could do additional rate hikes. That is restrictive financial policy or restrictive fiscal policy. So they want to keep hiking until the economy and the jobs market especially tells them, hey, stop. He also reiterated the 2% target for inflation. And that is, in my opinion, problematic. And here's why I think that's problematic. So in 1996, Fed policy members behind closed doors, that's an important note to have in the back of your mind, behind closed doors, they said, hey, look, we should probably come up with some kind of target for inflation, but I do not want this leaving this room because if it leaves this room, it will no longer become a target. It will now become just policy. Overnight, it would become policy. We do not want that to be the case. That was Alan Greenspan at the time. He was the Fed chair, and he knew if it got out of the room, that would become policy going forward. Well, fast forward to 2012, and Fed Chair Ben Bernanke publicly announced 2% was the inflation target. This was Alan Greenspan's worst nightmare, and he turned out to be very prophetic, which is Ben Bernanke came out in 2012 and said, hey, we're aiming for 2% inflation. To this day, the Fed has been beating that into everybody's head. We are aiming for 2% inflation. We're aiming for 2% inflation. Not a whole heck of a lot stays the same for 27 years, unless apparently it's the inflation target for the Fed. Alan Greenspan knew that would become policy, and sure enough, it became policy the day Ben Bernanke came out and said it. So that's what the Fed's aiming for. They're not easing off of that. They reiterated that same target, and that is what the Fed is aiming for. Now, why is this important? Well, we got updated inflation figures. And if you recall my update from last month, I said, hey, I'm actually expecting kind of a rough month for inflation. Well, turns out that was true. The reason I saw that happening was because we were going to be replacing a cooler number from a year ago. And that was going to cause inflation almost in and of itself to start to increase a little bit. It's not a reflection of what the numbers did in July. And again, those July numbers get reported in August. It's really a reflection of the report that was getting replaced from a year ago. So as a reminder, in June, saw significant improvement. Consumer price index, inflation as you and I, us consumers feel it, decreased from 4% to 3%. It was once as high as 9.1%, so making significant improvement. In July, though, it came in at up 0.2%. Up 0.2% is not a bad number in and of itself. Again, it's really not that bad. But the year-over-year figures increased from 3% to 3.2%. Because again, we were replacing a much cooler number from a year ago. Producer price index, that's inflation as companies feel it on the wholesale level. In June, that decreased from 0.9% down to 0.1%. It's once as high as 11.7, almost 12%. In July, that increased 0.3%, but the year-over-year figure increased to 0.8. So flipped on its head, 0.9 down to 0.1, up to 0.8. Like, again, it doesn't have a whole lot to do with the numbers that were being actually generated. It had everything to do with the numbers that were being replaced from a year ago. Now, putting things in perspective, if the inflation increased 0.2% or 0.3%, and we took that and we extrapolated it over an entire 12-month period, that would only equate to 2.4 to 3.6% inflation. That's not that bad. However, it's above the Fed's target of 2%. So that's why when the Fed reiterates this target for inflation, it keeps the markets just constantly on edge. Like, how are you going to get to 2%? That's a crazy number. It's a crazy number that was established back in 1996. And they didn't even want that to get out. So why is this number just gospel? Why is this exactly what everybody is aiming for to this day, 27 years later? It just doesn't make a whole lot of sense. But until the Fed changes their stance on that, until they come out and say otherwise, that is the target. That's what the markets are hoping for, and that's what ultimately everybody's going to be gauging actual inflation improvement against. So it's worth keeping an eye on. It's a little bit frustrating, but it is what it is. Until the Fed changes their tune, it ultimately doesn't matter what us muggles feel like. So another thing, home values. I've put a similar slide. This comes from my friends at MBS Highway. It's a subscription service I belong to that shows me what's going on in the mortgage-backed securities market. But they show that home values have hit all-time highs on every metric except for one. So if it's yellow, that means that that's the month that it hit all-time highs. So FHFA, Federal Housing Finance Agency, CoreLogic, Black Knight, Zillow. These are kind of aggregators. Case-Shiller, that's the gold standard for appreciation. That is just slightly behind all-time highs. Anticipating we'll hit that all-time high with Case-Shiller in the next month or two. So real estate continues to improve quite well. Pace for appreciation for real estate between 5% and 10% year over year. Like, that's fantastic. So despite the high interest rates, and you saw a lot of headlines this month about rates hitting like highs for like the last 21 years. Despite that, real estate is performing very well because of a lack of inventory. So if there was a lot of inventory, we'd be seeing something different happen in the market, but there's a lack of inventory and there's still houses being gobbled up. So all in all, housing market is very supportive of home values, despite the fact that rates are so high. So that's good to see. All right, looking ahead. So updated inflation numbers on the 13th and 14th of September. Remaining Fed meetings is on 9/20, so September 20th. That'll be interesting because the Fed did not have a meeting in August, fortunately, because we got, again, some kind of rough inflation data. This month's inflation data should be better. So hopefully the Fed takes the most recent information with more value than the previous information. And then there's a lot of eyes on China right now. China's been grabbing a lot of headlines. They officially entered a bear market with their stock market. It was down 20%. Their unemployment among the youth was so high that China actually stopped publishing the data. You could never get away with something like that in the USA, but in China, it's pretty commonplace where they kind of mute the information that they don't want released. It was over 21%, I believe, when they stopped reporting that data as a whole. So all eyes are kind of on China right now. And they're kind of wondering what's going on. In addition, there's a number of large corporations, commercial real estate especially, that have either declared bankruptcy or missed a lot of payments on debt, and eyes are going to be on that as well, because if that starts to fall apart, it's going to have wide ranging effects, given how big the Chinese economy is. And then jobs report, literally going to come out tomorrow on the first. It always comes out on the first Friday of the month. It just so happens that the first day of the month this month is on a Friday. So yeah, that's what we're keeping an eye on. The Fed definitely desperately wants to see jobs numbers coming in cooler. If they do, that's going to give them more ammunition to not hike rates, to pause hiking rates. So the Fed wants to cause some pain in the jobs market. If the jobs report comes in soft, it's entirely possible that they skip hiking rates on the 20th when they meet again. If the number is great again, they're going to feel empowered to continue to do so until it doesn't show up that strong. Why do they want to cause pain in the jobs market? Because job gains are inflationary. When people get jobs, they typically get paid more money. If they're getting paid more money, they have more money to spend, and that causes inflation. So that's what we're looking out for in the month of September. Can't believe it's September already. So that's it. I hope this is helpful. As always, thank you all so much. And if you have any additional feedback from me or my team, please let us know. And as always, thank you so much for the referrals. It is the lifeblood of our business, especially right now. So thank you. Appreciate you all. And if you have any other questions, let us know. Appreciate it. Thanks. Bye.